Hi, I am Jennifer Harder, your financial educator. Today we're discussing step 2 of the simple steps to financial success, and this is taking inventory of where you are. So hopefully by now you've watched step 1, which was, committing to what you want to do. And so today, now that you've committed to making a change and doing something different, today we're going to discuss actually taking inventory. And so, I know most people, when you think of inventory, you think of like store inventory, where you're finding out, what your stock is on a given day. Not quite the same thing, although semi-similar. So more like, if you're getting ready to go on a road trip, or, if you've ever been lost, the first thing somebody asks you is, where are you? And so if you're using your GPS, you're usually starting from your current location. And if you're ever lost and you call somebody up and ask them for directions, they're going to say, where are you? And so, you need to know where you are now before you can figure out how to get to where you want to go to. And so this step is very important. It may not be the most fun thing to do, but it isn't too difficult either. And so, and it's actually so simple. You can either do it on if you like to use a spreadsheet, you can do a spreadsheet, especially if you like to track it over time and see how things have changed. You can do it on a sheet of paper. There's no real rules or anything like that as how, the right way to do things, whatever works for you. But it is, you need to know where you're at. So usually the easiest one for people to figure out is your revenue or your income. And that's, it's usually your paycheck. If you have any self-employment income, residuals, dividends, if you are receiving any rents, any, let's see here, alimony, child support, pensions, anything along those lines, any money that you get coming in every month. And usually it's pretty easy if you look at your bank, because you get these things, if you look at your bank statement, if you're receiving this income, regularly every month, it's usually pretty easy to pull out how much has been deposited into your bank to figure out what those amounts are. And then, on the opposite of that, you're going to have your expenses, which is a little bit more difficult. If you can get a 1-year sample, that's like the best, because then you have all the seasonal variations, because, within the course of that year, you're going to have, winter versus summer, especially for utilities. If you've gone on vacation, if you have, had holidays in there, going back to school where you might have more expenses because you're buying back to school supplies. You get the idea. But at the very least, do a week's worth and just kind of see where your money is going. Because a lot of times you spend, a few dollars here, a couple dollars there, a couple cents there, you're buying that candy bar or that coffee or lunch out or whatever the case may be. You're not thinking about where the money's going. So having an idea of where your money goes is very, very powerful, because what you can track, you can change. And so you want to go through and, figure out what your expenses are. The easier ones are going to be your rent or mortgage, because that's the same every month. Car payments, because they're generally the same every month. Student loans are generally the same every month, things like that. So, you really want to know like how much you're spending on groceries, whether it's just at the grocery store or your groceries, maybe more of a food budget where you have groceries and dining out. It's up to you how you want to break down those categories, but do whatever works for you and how you want to do it. You want one for gasoline, you want one for, maybe just personal expenses or, gifts, whatever the case might be. You get the idea. And so that's really important. So then you have both sides of that. So you have your revenue and your expenses. And so the money that's coming in and the money that's going out. The next one is going to be your liabilities. And this is something that a lot of people really don't know off the top of their heads, because this is what you owe to other people. And so this would be your actual balance on your credit card. This would be the actual balance on your mortgage, the actual balance on your car loan, the actual balance on your student loans, if there's any personal loans, things along those lines are going to go into there. If you borrowed money from your 401k, wherever the balance is on that, not the monthly payment that you're making or the biweekly payment that you're making, but the actual balance of what you owe going out. And then the last one is going to be your assets. And this is anything that you actually own that's of value. So if you paid off your car, it would be, what your car is valued at. And you can find that using any kind of online car calculator. It could be, if you've bought a house, let's say the house is worth $100,000. So you have a $100,000 asset. And then you may have, say, a $40,000 liability because you still own $40,000 on that mortgage. So your house could be an asset and a liability. Same thing with a car. If your car is worth more than what you owe on it, it's also an asset. Now, by that same, the flip side could be that you actually owe more on the car than it's worth, or your house as well. I mean, hopefully not, but when you do have some assets, you may find that it may be that you have more asset than you owe, or it may be that you now owe more than the asset is valued at, and there's different things. But at least then what what you're working with. And if you haven't had a current appraisal of your house, you can look at comps online and kind of see what's sold in the area and find something that's similar to your situation, and use that as what the value of your house is. Or you could just use what you purchased at, and you go by that assumption. If it's been a while, or if the housing markets have changed, it may not be quite as accurate, but at least you have something. It's, or you can even ask a realtor, what they think it'd be worth. It's not obviously, the value is going to be what everybody's willing to pay on it, but at least you have some idea of what you're working with. And when it comes to your liabilities or your debts, there are both good liabilities and bad liabilities, or good debt and bad debt. And so what you want to do is anything that's costing you money is, I guess I should say, if it's costing you more money than it's making you, that's what you consider like a bad debt. And that's what you really want to get rid of as quickly as possible. So that tends to be your credit cards are like the biggest one, the biggest offenders, I guess, if you want to call it that. Followed behind by, you have student loans, you have, your mortgage actually tends not to be so much a bad debt, mostly because your house is getting value, you're getting equity. Unlike a car, where the car is depreciating and it's not going to be worth, in X number of years, it's going to be basically worthless. The expectation is that your house, once it's paid off, will still be worth, something. And if nothing else, the land is worth something. And so that's like, that makes it a lower priority for paying off. So where liabilities are really powerful is when making the decision to take on more debt, or making the decision what debts to pay down and prioritizing them. It's very important to know, what the differences are between those. And then and also as far as liabilities go, because, that's like the name of the game, is to, most people say they want to be debt free. And that's not necessarily the best game plan, because some debt, like I said, is good, like your mortgage, or if you're buying a rental property and you take a loan out for it, that would be considered a good debt, because in taking out that money, you're going to be making a lot more and, gaining a good asset. But you want to take a look and see what works best for you. Some people like to do what's called the Snowball System, where they will take and pay a little bit more on one of their credit cards. And then once that is paid down, they will take that money that they were paying into that credit card and then start applying it towards the next credit card they're going to focus on. So say you have 4 credit cards of, various interest rates, various, balances. You may want to start with the smallest balance and, focus on getting that one paid off. And then as soon as that's done, whatever, say you're paying $100 a month on that to get it paid off, take that $100, apply it towards the next credit card you're going to focus on. So you take whatever you're paying on that second credit card plus the $100 and make that the new minimum that you're paying on that credit card every month until it's paid down. And then you take that net amount that you were paying on that second credit card and start applying it towards the third. Once again, some people like to start with the one with the smallest balance. Some people like to start with the largest balance. Some people like to take the highest APR, and other people take, the lowest APR. Although most people don't take the lowest APR, it's an option, but not one that most people take. And so that will definitely help you in in getting those credit cards paid down. And then there are other things as well that, if you have a car payment and your car is worth less than what you owe on it, you may, or your house, if you're under what they call underwater, which means that you owe more than it's worth, then you may want to focus on paying some of those down so that you can get out of debt and just have what's left of it, especially with the car. Not so much with the house. The house, it's okay if it's underwater. It's not the end of the world. Obviously, if you want to sell it, it's an issue. But the thing is that, at the end of the day, the house is still going to be worth something, whereas the car will eventually be not worth anything. And so you really want to, get those cars paid off sooner rather than later. It's always nice if you can get the car paid off. What I've recommended to people in the past is to, take out that 6-year loan on your car, but plan to pay it off in 4, because most warranties will go until the car is 4 years old. And that way the car is paid off by the time the warranty is done, and especially if you have an extended warranty. But get that paid off so that way if there is a major expense or the car just completely dies on you, you're not having to roll that amount into the next car loan. The other thing you do too with that is take whatever when your car loan is paid off, or your credit cards are paid off, or whatever the case may be, take that money and start putting it into whatever your next goal is, whether it's going into an account specifically for your next car. When your car is paid off, take that $300, $400, $600, $800 that you're paying on that car, just keep depositing, because you're used to making the payment. Just deposit it into an account so that when the car does either need repairs or dies, or you just feel like trading it in, whatever the case might be, you have something towards the down payment on that next car, or to pay off that bill. Same thing with your credit cards. Take that money that you're used to paying on them anyways. Once they're paid off, keep depositing it into an account that you can use for emergency savings or investing, or whatever your bigger goal is. So, there are quite a few ways of looking at it. But once again, you're not going to know where to go unless you know where you are. And so even though this may not be the most exciting exercise in the world, doing it at least once a year, I tend to do it about quarterly is when I tend to do it. Sometimes more often, but generally quarterly. I take stock of where I'm at, what I have, what's going on, so that I can update my spending allocations. I personally call them a budget, but I know a lot of people don't like that word. So if you're like anti-budget, then please, by all means, call it your spending allocation, your plan, whatever the case might be. But go ahead and see where the money needs to go and how to do so in a way that will best help you pay off the quote unquote bad debt and be financially stronger. So on that note, if you have any questions or concerns or comments, please leave them below. And, and as always, please let me know how I can best support you on your path to financial empowerment. And I am once again going to encourage you to please join the free Facebook community, How to Be a Money Master. It's at https://www.facebook.com/groups/how-to-be-a-money-master, and let us share in your journey. We love to support you and bounce ideas off each other and share those wins and learn from the mistakes that we make, because together we are so much stronger. And so please, on that note, everyone, have a wonderful day, and I look forward to seeing you next week.